Last week I didn't hit record until 25 minutes into the talk. All right. Welcome everybody to the REI Education Club at Intel. My name is Daniel Homland. It's good to have you all here. Today, our two speakers are Jen, and tell me if I'm saying your name right, but Katsev?
Katsev, yes.
Katsev, okay. And Ganga Tawardi.
That's right.
All right. And we're going to wait just a few more minutes to let people come in. And so while you're here, you know what? Let's do something new. Let's wake people up a little bit.
Yes.
While you're here, can you type in where you're located so that we know where in the United States or outside the United States you might be? And we'll just let everybody. You're going to see the majority of people in Portland, California, and Arizona. But I'm in Portland, Oregon, Mesa, Arizona, Chandler, Arizona. That's great. And Jen, where are you coming to us from?
I live in Plovdiv, Bulgaria.
You live in Bulgaria.
That's right.
Ganga, where are you coming to us from?
Florida.
Florida. That's a nice area.
Yeah,
What time
Orlando.
is it in Bulgaria right now, Jen?
It's 9 p.m.
Oh, okay. That's not as bad as I thought it would be.
No, we had daylight savings last week, and you haven't had it yet this week, so we're 9 hours apart instead of 10.
Okay.
Yeah.
Folsom, Hillsboro, Folsom. I'm in Florida. Oh, that's Ganga. Scottsdale, Arizona. So we've got representation on Arizona today.
Nice.
Hillsboro. Hi, Gary. I'm probably your neighbor.
How you doing?
I live over by Brookwood Elementary, if you know where that is.
I live a block from Coyote's Bar and Grill.
Oh, we are neighbors then. You're like a 3-minute drive from me.
Oh, that's funny.
So I'm noticing I'm not allowed to share my video and my screen at the same time.
We'll go for your screen.
Okay.
All right. How many people do we have here? We're hitting 69 people in the group. We can go ahead and kick it off. The only announcement that I have to make before we get started is that every 6 months or so, we want to put out a new call for people to join the REI Club leadership team. What that involves is basically going through and helping to find guest speakers, helping to maintain the video site and the SharePoint, posting events on Yammer, and then just going through and discussing and approving the people that are going to be our next speakers. So if you would like to be involved in that, please, we're looking for volunteers right now. And just email me and we'll get you into those meetings. It's a half-hour meeting once a month. So it's not a huge time commitment. And we just go through and approve speakers. And I don't think we've not approved one yet. We usually try to find good ones. All right. That's the only announcement I have. Jen and Ganga, I'll turn it over to you.
Okay.
So first of all, thank you, Daniel, for having us. It's really an honor to be in this group and to share a little bit of what we know and what we do, and hope this is going to bring tremendous value. And we would love to have people participate via conversation as well for different sections of this to the extent possible.
One thing really quickly, we tend to have our questions put into the chat box. And so what I'll do is I'll monitor that for you so you can concentrate on your talk. Don't worry about it. And I'll just pull out good questions that are well-timed, or we can hold them to the end. But don't divide your attention. Concentrate on the talk, and I'll handle the chat box for you.
Great.
Okay, perfect. Thank you so
Our
much.
style is to be really interactive, by the way. So we will be asking the audience questions. If you want to unmute yourselves and even say something or type in the chat, whatever this, I've never used Teams before. So we like to be very interactive.
Yeah.
This is watching TV.
Yeah. And this way we can have fun, we can exchange ideas, and it would be more proactive. And that's what we do. So with that, let me get started on introductions here. So let me tell you a little bit about Jen. Jen and I became friends 5 years ago. We sat next to each other in a personal development course and bonded very well on what we really want to do in our life, which is we really wanted to make a difference, build communities, and we wanted to coach people. And that's what got us started on getting to know each other. And over time, I started to go to BACOM, one of Jen's groups. And Jen, can you tell us a little bit about how you got started in creating that group?
Yep. Have any of you, are any of you in the Bay Area? Yeah, actually, I do see people here. So if you remember, I started this group in 2019 called the Bay Area Commercial and Multifamily Investment Club. We had meetings mostly in Santa Clara, and it was mostly to help Silicon Valley high W-2 earners learn about how to invest passively in commercial and multifamily syndications. So I ran that group for 2 years before I moved to Bulgaria, which is where my now husband is from. We have a business here as well. And basically it was all about bringing key speakers like the chief economist of Fannie Mae, people who've developed over $1 billion in projects to the club to share the best of the best knowledge with our audience. So I think this is actually quite a relevant audience.
Yeah, so 200 people would show up to our events, glued to their seats and not wanting to get up. There was free food, but no one got up.
And bathrooms.
Yeah, and no bathroom breaks. No one wanted to get up because it was informative to the degree that everyone thought that they really did not want to miss out on any section of what was going on. So I started to just initially go there only to support Jen. And then I saw, oh my God, I was learning so much about different asset classes, tax rules. What do you need to watch out when you buy commercial properties? How does apartment building investing work? How does multifamily work? How does industrial work? How does commercial work? Like there's so much to learn. And all these top people were taking their time and effort to educate us on like 20 points that you must learn before you get into this asset class. These are the things that would make it easier for you to make the decision on whether you want this property or that, which one makes the most sense, right? So I got to learn a lot, and my passion is due diligence. So with that said, I'm going to have Jen, why don't you tell us a little bit about like how did you get recently started into the 506 Club, and what do you do in the club?
First of all, I just want to say a few words about Ganga because she is so generous. And she really is a master in negotiation and really understanding how to put together a deal. So I really love that about her. And I really love that really, when we say making a difference, I know it's a very used a lot word nowadays, but she is one of the most compassionate, powerful, really about making a difference for people that I've ever met. So I'm very happy to be her partner. Both of us having had financial services backgrounds, but also being coaches and helping people achieve whatever goals that they want in their life. So I think it's just an amazing combination of skills that we align on and share together. Now, 506 Club is my online community for connecting passive investors with syndications and educating people from wherever they are about investing in commercial real estate through syndications. So the purpose of this presentation is not so much to talk about we're not here to sell you anything. We don't have any deals that we're going to be talking about. But if you are serious about building something for yourself or investing, come talk to us offline outside of this presentation. So with that being said, do you want to say a few words about our company, Infinite Performance? And then I will start to share my screen here.
Yeah, so the other thing we share in common after BACOM, Jen had me work at the firm she used to work for. And so I learned a lot. And one of the experiences that we bring is we've also worked in syndication firms. And so what we realized is how can we do this better, right? So my background is in neurolinguistics. And so I took that background, and I saw a lot of people wanted to move from W-2 to investors, then syndicators, or just get out of their W-2 job and invest more. So we also have a coaching aspect of our business and consulting aspect that motivates us to do very well so that we can share that information with people and make a difference in that way as well. So Again, I'm not going to be specific about things, but what we learned is that there's lots of ways to do these things, these deals, to live our lives, to become better at performing. And we bring that experience when we share about what we do. And we're going to be sharing some of the things we've learned with you guys today. So feel free to ask a question in a chat again, or we will have portions where you get to participate. Please participate. It will be so much fun. And learning is fun when we participate. So thank you. Back to you, Jen.
Yes. So let's talk a little bit about why industrial. First of all, I think you guys are all familiar with syndication, since Daniel probably has done a really good job at educating you about how to get involved in big deals right away versus working your way up the traditional path, which is going from single family, and then maybe a duplex, and then maybe a fourplex, and then maybe larger multifamily, maybe into commercial. You can just go straight for the big games if you understand what you're doing. So why do we like industrial? A little bit of background you may have seen in the previous slide. Ganga and I have raised capital probably 25 million in the last 4 years for every kind of commercial real estate asset out there, including multifamily, retail, office, industrial, raw land entitlement, assisted living, the whole gamut. And we don't say one asset is the best asset out there, but every single type of real estate asset has its own market cycle. So it's really good to diversify and know about as many types of assets so that you can make the best choice depending on the market cycle that we're in. I will say that the higher up you go, the harder it is to penetrate an asset class. How I got into industrial first was, as an employee, I had raised about $7 million for an industrial syndicator. And after that, I had passively invested 5 times as an LP in different industrial deals. And this beautiful one up here in the upper right corner is actually my first ever real estate investment. It was not a single family rental. It was not a multifamily, although I do own multifamily and other types of real estate in my portfolio today. This was actually my first investment, and it had a nice exit last year. So I'm very happy about that. Now, there are many different types of industrial. Just like within multifamily, right? You know, there's class A, B, C, you know, there's high rise, there's garden style. Within industrial too, there's different kinds. So we have heavy manufacturing. With heavy manufacturing, so you have like your auto manufacturers, for example, in this picture. It's really, really hard for them to get up and move. It's not like someone who moves one day from their apartment to another, right? So there are some benefits with having a tenant who is highly likely, highly invested in that property with long-term leases. Yet, if you have a vacancy, you need to make sure you have someone on your team who really understands how to turn that around, because usually they're also located in more remote areas. Then we have light manufacturing. So this is a soda manufacturing facility, for example, not so heavily invested. And then we have distribution centers, like your Amazon fulfillment centers. Then the most important thing with these guys is proximity to major highways and transportation. If it's a last mile distribution center, then proximity to a major metro is also going to be a factor. Flex industrial operates a little more like your office and retail. It is more dependent on where businesses are located. Usually these guys are located in the industrial zones on the outskirts of a metro. But unlike these assets, it is more dependent on population. And then we also have R&D, research and development, laboratories, etc. And then we have our warehouses. So that just gives you an idea of the kind of industrial when you hear people say industrial. So there's also several differences between the kind of leases that you see, not just in industrial, but also commercial real estate in general. How many of you here, if you can just type in the chats, how many of you have either been a tenant, or especially if you've been a landlord, actually? Is there a way to do like a Landlord, yeah.
A poll?
Yeah, can you do a poll?
I think there is, but I'm not sure how to do it.
Okay. Alrighty.
I will work on figuring that out. Somebody
Raise
can
hands.
IM me and say no.
Okay. Yeah, we have a lot of landlords in here. Okay, great. So all of you landlords, answer this question for me. How many of you have ever had to, when you have repairs, like let's say the AC breaks or the toilet breaks, who pays for that repair?
Landlord
Yeah,
usually.
landlord does. Yep, landlord usually does. And then who pays for property insurance and property taxes?
Landlord.
That's right. Yeah. And so even though when you buy a property and it's supposed to be spitting out 10 or 20% cash on cash return, you have all these things happen that you sometimes don't have control over. Okay, Jeffrey says the tenant pays. That's awesome. You got a special lease there. It is a lease that you typically do find in commercial too. So that's awesome, Jeffrey. With commercial real estate, it's actually the tenant there's something called a net lease. So a net lease means that the tenant pays for, I'm actually going to show you, a triple net lease is where a tenant pays for the property taxes, property insurance, and the maintenance. And there's different types of these. So a double net lease is when the tenant pays for property taxes and insurance. And a regular net lease can refer to they pay for either one of these things. Now, when you have a triple net lease, because the tenant is a company, right? If their toilet breaks, they got to fix that. They are grown up, responsible tenants. And with maintenance, what I've seen in these leases is sometimes it means they cover anything inside of the building. Sometimes it means they cover even the structure of the building, the walls, the roof, sometimes even the foundation, sometimes even the parking lot around the foundation or around the property. So when you have a really good negotiator on your team, you can often get a absolute triple net lease with all of these things where the tenant takes care of everything. Although depending on the type of tenant and how committed they are to the property, you'll see different things. Like for example, if you have a multi-tenant industrial property with that's light industrial or flex industrial, and they have 5 to 7 year leases, you're more likely to see a double net lease. So it just really depends on what's typical for that asset and that market. This is what a financial statement with a regular financial statement, I guess, of a real estate deal would look like. You have repairs, advertising, admin. This is probably multifamily here. You have management fee, insurances, utilities, etc. And then with a triple net lease, you just have your gross rent, and that is your net operating income. So there are also different industrial lease terms, which, as Harjot was saying, yeah, this applies to most commercial. So these terms you'll see in commercial real estate. What makes industrial really unique, and especially the industrial deals that we do in the manufacturing space, you will see leases that are sometimes up to 25 years long. This means 25 years of set it and go. No active management. It's completely passive. Triple net lease up to 25 years with annual rent increases. Depending on how quickly the market appreciates, typically you'll see 2 to 3% annual increases in the rent. And then renewal options. So what I've seen sometimes with these 25-year leases is 2 10-year renewal options, because the tenant's also really committed to being able to stay in that property. And I'll explain a few scenarios where you see these kinds of leases. And then lastly, because these are companies, you have a master guarantee. Just like in an apartment, if you have invested in student housing, then sometimes you will have the student's parent sign on and master guarantee their lease because the student doesn't make any money. Same thing with these deals. Often when we buy a location that's part of a company's, one of the company's locations, the parent company will guarantee that lease and honor it if it defaults for the entirety of the lease term. If you have a really good negotiator on your team, these agreements are watertight. Under no condition can they bail out. They're pretty genius. And then as a landlord, you receive a fixed rent and you have no surprise expenses. So basically, all the heavy lifting is done upfront in the negotiation. So where do you see these kinds of deals? First of all, I want to explain what a sale-leaseback is. This is something that we like because, yeah. So Pompey, we're going to talk about risk management in the next slide. Great question. A sale-leaseback is when a tenant who is also the owner of the property, let's say they built this building 50, 70 or so on years ago. We tend to go after properties that have been in tenants that have been in the property for at least 60 years. That's just our personal criteria. They have all this idle equity sitting there from when they built the thing way back when. And so as real estate investors, it's the same principle. When to do it is you always want to buy distress at a discount. When do you do this with a company like this, or sorry, with a tenant like this, is usually during a reorg. During the beginning of COVID, we also saw a lot of companies struggle, and that's a good time to come in and start negotiating for favorable terms. So the company can take this idle equity that's sitting in their real estate and then use that to pay down long-term debt or reinvest in their operations. And the best part about these kinds of tenants is that they are the most committed tenants because they have been occupying that space for 60 years. This is a deal that we took down in recently, 2-3 months ago. And they have been in business for over 60 years, and their parent company had guaranteed the lease. That parent company has been in business for 175 years. And we're going to talk a little bit about the due diligence that's involved when you evaluate a deal like this. So I will kick it over to Ganga to talk about the due diligence section and all of the risks. Before you do that, I see a question. What is the best source to find a sale-leaseback offering? Actually, Ganga, you can answer that one as well. Oh, you're muted though.
Before I answer that, right, I'm going to go over risk and then we can answer the question about where you can find deals. Okay. So risk, right? Like anyone here has swum with sharks or knows anyone that has swam with sharks?
That's actually a picture that I took with my phone underwater, like the same day as the picture above.
Anyone? Vote of hands or chat? Anyone willing to answer the question? Yes. Okay, Jeffrey, you have. No, Jessica. Awesome. Yeah.
I was like Jessica too.
So, Jen, I have a question for you in that
What's
case.
up?
Is like, did you swim with the dangerous shark or what kind of shark did you swim with?
Okay, so you blew my cover. This is actually a nurse shark. And let me just give you a little backstory. This will all make sense in a second. I went to this investment conference that had a beach component to it. And the first year I went to this investment conference, I was snorkeling and got a panic attack because I was afraid of how vast the ocean was. And I had a panic attack in the middle of the ocean. Second year, I worked on it and I could not be more than like arm's length away from the boat, and I could not enjoy the colorful fish or anything like that. And then I worked on it more. And then this year I made it my goal to swim with the sharks, but the safe ones. So this is actually a nurse shark, but I still did it.
Yes. And you took all the precautions, you got the coaching, you set yourself up to win, and then you went and did it. So it took 3 tries. Each time she got better and she had the training. So I'm going to share something about Jen here. She's a avid trained like a professional swimmer too. So that's important. And it goes right into, thank you, William. Yes, takes courage. It takes, she set herself up to win, right? So yeah, thank you. So that's what we're talking about when we talk about risk. There's known risk and there's unknown risk. And making the known risk, covering all your bases with the known risk, and making those unknown risks into known risks is something we do in this business a lot. And those who become really, really good at this are the ones whose deals get reliable, safe. They've done all their due diligence, they've done all their homework, and we feel comfortable over time to invest with them. And I say over time because of track record, right? We love to look at how are they looking at the property risk? Where is this property located? Is the tenant, the environment supporting this business? Is it in a place where there is violence? Is it in a place where there is no access? Is this in a place with access? Now, with each of these things, there comes a risk with it. For example, it might be talking about certain kinds of properties where it is in a certain neighborhood and you know that it is risky. So how would you mitigate that risk? Or would you be interested in that risk? Now, risk is there in everything, right? For example, we take Coca-Cola, we drink Pepsi or Coke, right? Or any kind of soda beverage that may not be healthy for us. And then we have smoking, drinking, other things, right? And we don't look at it as it all has risk. This risk is better than that risk. The truth is it all has risk and it all has consequences. The degree of consequence is different. And that degree, when it becomes something that you get aware of, you learn how to mitigate it, and you get the tools that that over time you've spent a lot of money. Most people in industrial have spent more time with their lawyer, somewhere around the range of $250,000 on the lawyer on that deal. And they do all the due diligence that goes into each of the components, which I'm going to go over right now, which is property risk, lease agreement risk. That is the lease agreement that they will not renege on that lease. That's a 25-year-old lease, and you want to make sure that they will honor no matter what happens. Lease guarantor risk. Who is guaranteeing this lease, and what are their financials looking like? Now, when they do background checks for these things, they actually go and look at the guarantor's history. What assets do they have? How much is it secure? How secure is it? Are they worthy of that? Are they relying on somebody else to pay for it if they can meet that obligation? Who's actually going to pay for it if they can meet that obligation? Do they have family assets? Are those family assets covered in this agreement? Is it secured risk versus unsecured risk? And the tenant's business, how industry specific can we get? How safe is this industry? And I'm going to talk to you a little bit about the things that people usually don't talk about, which is, an investor has a particular perspective on how it looks like from the outside. So Jen and I have a lot of different kinds of environmental experience. Like, for example, we've worked for syndicators, we've syndicated ourselves, and we have also invested, right? So we have three different perspectives. So when you come from different perspectives, we realize that an investor looks at it from a different perspective. A syndicator has to look at it for what's good for everybody, not just one person. And then one of the things which is beautiful that we have about this industry is it's one of those well thought of strategies. It comes with the exit known, like in this situation, we're going to exit. Under these circumstances, we plan to exit. If we have all these knowns, we will do this. If we have unknowns, we will do this. So for example, industrial deals usually have like a plan A, B, C, D, E, F, G sometimes, which is really awesome about this particular asset class. Now coming to tenant risk, right? Like, is this tenant sound? There's like so many layers of looking at it, right? Tenant is sound, tenant's business is sound, yay, great. No, they go to tenant is sound, tenant's business is sound. Who's going to take over the business if something happens to this person, right? The main person who owns that business. How is the master lease going to affect the, is there a parent company that can be responsible for that lease? How sound is the parent company? How sound are the owners of the parent company and the P&Ls? So can you imagine how much risk mitigation we do, or how much planning goes into this, and how much thorough due diligence goes into it, right? And then legal risk. Like, if this happens to the property, if the earth moves under it, if these things go perfectly the way we want, if this suddenly goes out of, these people go out of business and the worst happens, like, I think, who was it, Jeffrey, that asked a question, right, about bankruptcy. I'm sorry, I don't remember the name, but the person who asked about bankruptcy, right?
Michael.
So, Michael,
No,
sorry.
it wasn't. It was Pompey. My bad. They
Okay,
all ask good
Pompey.
questions.
Yeah. So Pompey, thank you so much for asking that question. So in case of bankruptcy, who is in first lien? What is their credit history? What do they have to lose by declaring bankruptcy? Do they have other assets we can go after in case of bankruptcy? And is that asset ready to sell under those situations? Let's imagine a situation where something happens and that property is at risk, that business is at risk. Will the kind of properties held in that portfolio, is there any property that will sell under any condition? We try to get that property in the contract so that that'll protect the syndicator, and it'll be easy to sell. So we also see, will it be easy to sell? How fast can we sell it? And will that cover everything? So that is the kind of collateral we look for. Or many of these loans have guarantees. So the guarantor has a guarantee with the bank. It could be secured with a property. The owners and the business owners could have cash, right? The syndicators are securing these properties, right? So they have that, we have that protection given to investors. But then how sound is everyone? How many years have they been that sound, you know? So a lot of analysis goes into this, a lot of background checks goes into it. And these deals typically take about 2 years to negotiate. And over time, you get faster to about 18 months to negotiate these deals. So loan risk, right? I'm going to talk about loan risk and then employee risk. So loan risk is, can this person pay this loan? If there is guarantees for these loans, then under what situation does that guarantee not work? Because even the most airtight loans have guarantees. Like, for example, the loan guarantees that you can walk away from the loan, right? What is it called, Jen? The specific term for that?
The carve out?
No, that's there's a specific term, right, for, huh? I'm sorry. Okay, so this specific loan guarantee that mitigates risk against the loan, which CMBS loans, sorry. CMBS loans protect you from walking away in case something happens. But in that case, under what situation does that guarantee work and what situation does the guarantee not work, right? So for example, if you didn't disclose to the bank everything going on, let's say it was a vacation time, it was Christmas time, something happened, you didn't really get a chance to look at what's going on with the property, and things went out of hand, and you didn't let the bank know, now you become liable even though you have a guarantee. So these are important things that we go through with due diligence, but what is behind that risk and what's even behind that? So we try our best to mitigate every possible risk. And having said that, there's still lots of risk, like employee risk, recession, right? Things happen that are not in our control. So for example, like let's say there is a lot on the property. Now, can we build something so that as we go into recession, we can get some tax advantage out of it, right? So that's something that you can plan ahead to mitigate risk. Now, employees. So these contracts have the kind of guarantee. For example, when there's a particular syndication going on right now, which is about the risk of covering who is going to be the CEO next. If something happens to this person, who is the main person? And if they are, let's say, they're seniors, they're in their 90s, who's going to take over next? What is the experience of that employee? So mitigating against every possible risk is just the beginning of considering that deal, right? So a lot goes into the due diligence, credit checks, background checks, to find out if this deal is worthy. And then after that, we go into negotiation on the property, which Jen can talk about next.
So I'll just add a little color to this, right? Using a real life example, or real life examples in general of the kind of deals that we look for. So the industry risk is we always choose tenants, especially with these longer leases, tenants that are going to be around for the long run, right? So generally, when you have a tenant who's been around since the Great Depression, they have gone through the worst, they have seen the worst, and they have been through many market cycles. So that's a good point. But then are they going to be around going forward? So some industries that we like, for example, are my first deal was in an air and water filtration company. We've done hard packing foams. We look at the kind of contracts that these tenants have if they're in manufacturing, such as if they do aerospace manufacturing, do they have a good mix of long-term and short-term contracts, right? The aerospace one that we did was one of their main contracts was Boeing, and then the company ended up 3xing in terms of their revenues and expanding their real estate. So that was a really good exit. The most recent one that we did was in the decarbonization space. And so some of their contracts were even governments around the world wanting to, who have policies in place to reduce their carbon footprints or have zero net emissions. So these are some things that we look for. An example of the most recent deal that we did in terms of the other risks, having multiple exit strategies, right? So this property was a headquarter location, and we like headquarter locations because they are usually the last to go in a company's portfolio. And it was purchased distressed because they were having some financial issues due to the pandemic. However, we had also the primary plan was to do a flip in 2 years to stabilize it and then sell it off to an institution. And our broker partner who acquired the deal also has a lot of contacts in that space as well. So when you look at the financials of that deal, it's already written with the end buyer in mind, right? I'm talking about something in the 10 million range. So this is very different from a $1 or $2 million deal, right? We're talking about institutional players. The buyer pool is pretty small when you get to that level in this niche of an asset. And so you need to have a broker on your team who understands this type of asset inside and out. So to answer your question, Michael, we work with a very small set of brokers who specialize in sale-leaseback industrial. There's only a few dozen of them in the States that specialize in this niche that we work with, right? So, and that applies to every other type of asset out there, all commercial. You want to find the best in that specific asset. So with this one, the primary exit strategy was to flip it in 2 years. However, if that doesn't happen, it also happened to be located in an opportunity zone. There was an empty lot on this property that could be developed. It could be sectioned off and sold. Several things could happen to that property. If we had to hold it over 10 years, then we could fully realize an opportunity zone strategy. Since it was the headquarter location, it also had an office component to it. A lot of the employees had to work from home due to the pandemic. And so the tenant had already started to sublease that space out as additional revenue. But we also hired a leasing agent to come in and assess how this interior space could be subdivided if we ever needed to repurpose this office building as a multi-tenant office as its primary purpose. So there was like plan A, B, C, D. This is the kind of foresight you would need to make sure, because I see a lot of investments. I subscribe to a lot of different investments. I invest with, well, I follow a lot of people because now I do my own deals, but before I used to follow a lot of other syndicators and look at their deals. And sometimes I see these investment summaries with only one exit strategy. So look, one of the things as an investor, as a sophisticated investor, is to find out how many exit strategies, the more the better, that your sponsor can come up with, that they've already planned for. And then with this deal also, the parent company who guaranteed this property, we did due diligence not only on, so private companies require a private credit investigator. It's a lot harder to find out what's happening inside. So you need to hire someone very expensive and specialized to do that. And what he found out was not only about the company's financials and the parent company's financials, but also about the individual principals who own those entities, the individual owners of the parent, the individuals of the parent company had a family ranch that they hadn't inherited for like a couple generations ago that was valued at 17 million. So when I first saw this deal and I saw that the parent company's individuals had a $17 million ranch, well, what does that mean? For me, $17 million looks like this giant ranch that would take forever to sell on the market, right? So I actually called a broker and I asked them, how long would it take you to sell this ranch if we were to list it today? And he said, I could do it for under 6 months. That's what the market wants right now. So that's verified. Worst case, this thing sits for 6 months and then we can liquidate and use that cash to buy out this property. So that is the level of due diligence that we need to go into to make sure that all our bases are covered. Okay. And then regarding the actual negotiation of the deal itself, oops.
Hey,
We
I wanted to
mostly,
ask, I'm seeing the same
yeah.
SharePoint slide here on risks.
Mhm.
Is this the right one or did it freeze?
No, I don't have
Okay.
another one actually. It was just the
Okay,
next
so I
step.
was just checking.
Yeah, no worries. So the next steps to acquiring the deal is basically to work out the terms of the lease. It takes a lot of sophistication to be able to negotiate the best terms of the lease, to get someone to guarantee the lease. So again, it's really key. You have the most negotiating power when the person you're negotiating with is under distress. So we use brokers. We don't do it ourselves. We use brokers who really have a tight pulse on these types of properties. And
Hey Jen, could I ask some questions about just the different
what's up?
industries that you're in? So you've
Yeah.
mentioned industries that governments participate in, and they have certain metrics that they want to hit. How do you go about identifying an industry that you want to be in? Do you look, and just to name a few that maybe everybody's familiar with, but like restaurant or retail or dental offices, or how do you go about just looking or identifying an industry and knowing whether it would be a good one to be in?
We use our broker friends, so people who really understand that industry, and we leverage them a lot to be our expertise. And we do. It's very case by case because it has a lot to do with the tenant's track record. It has a lot to do with digging into their private financials, because usually these companies we deal with are private. But the amount of due diligence that you put into for a dental office, for example, that has a 5 to 7 year lease is going to be, and they're usually part of a multi-tenant property. So you have that risk mitigation by having multiple tenants, right? The level of due diligence per tenant is very different from a single tenant heavy manufacturing facility.
Okay. And Ashish has a question. How long do you typically hold these properties? What's the IRR range? And for those who don't
Am
know,
I
you should
allowed to
probably
answer?
yeah, that's fine. I mean, you
Okay.
could give specific examples or general ones, whatever you like. And you should
Sure.
probably
So,
define IRR also.
yeah, okay. So how long do we typically hold these properties? More recently, we're seeing deals that have a shorter hold period because a lot of people are wary of what's happening these days, where things are headed, and there's a lot of uncertainty. So I see much shorter hold periods actually. Typically before, like when I first started investing in these types of deals, maybe 5 years ago, I was seeing a lot more 5 to 7 year holds. What's the IRR range? So first of all, IRR is internal rate of return. It's a metric for annualized return that also factors in the time value of net present value of money. So the time value of compounding money. This does not factor in inflation. So IRR is usually lower than your average annual return. Typically what I'm seeing right now is anywhere between 14 to 18, depending on how stable the deal is, because you also have to take into account with these industrial deals, again, depending on which type they are, especially the manufacturing facilities, they are not located in markets that depend too much on population growth. So they're actually a lot more recession resilient and predictable in that sense, where if you know how like other assets like multifamily, office, and retail, if there's a population decline, it hits the business hard, right? With a lot of these manufacturing facilities too, they have a lot of automation and robots, depending on what the specific one is. So you don't see a lot of as much volatility, but the returns are also typically lower. So that's what you have to factor in when you're analyzing the IRR of this type of deal, is you're trading risk for reward.
That's a really
So
good distinction, that they aren't necessarily dependent on the same type of demographics that you would use in residential or multifamily or home living situations.
Yeah.
For people that were interested in investing in industrial, what should they consider when they're looking at an industrial sector? They say, hey, I like restaurants, I think they're doing great, or I like where data storage and data warehouses. How would you go about just starting to consider how that industry is doing and then connecting up with somebody in that industry?
So I can answer a little bit of that. So, like for industrial, which kinds of industrial, right? First of all, the syndicator will provide their homework. So that's a great starting point to get to know what's the syndicator's viewpoint, where are they coming from, how much homework they've done. So that helps us get started. And then we, as investors, do our own homework, right? So I apologize for this. I'm so sorry. So the due diligence on that done by us is we actually do very simple address checks, information checks on the company, income statements. That's how you can do at an investor level. At a syndicator level, we hire professionals. So those are two ways you can check. You can check the address this property is on. Does it say it's on sale? Is it looking for tenants? You can find that information just very simple Googling, right? But then
what about just somebody who's brand new and they have no idea what industry they want to invest in?
So let's say you're brand new and you're thinking so usually we have the other problem. You have a deal in front of you and then you learn that market by investing in that market. So that's one way of learning to invest. You invest in a couple of deals, and as you invest, you go along and I like this more than that. But then if you want to look for specific deals, we can say we have how we have done it is we've built connections over time. We've built communities over time. We go to people that have invested in this market over time, and if we talk to people, we are part of their groups, and that's how
We've
we
been
got,
passive investors.
yeah, and that's how we got into who has these deals, where can we go to find that specific deal. Like, let's say, do you want to talk about specific deals, Jen, like filtration products or uh, beauty products, things like that that you have?
That's true, yeah.
Yeah.
There's
Or
a lot of things I've learned through being a passive investor first in how these deals are structured, and then how do they behave over time? Like, is it really as set it and go passive as they're advertised? And for the absolute triple net lease ones that I've done, yes, they actually are. I have asked a lot of questions to the sponsors, but you also want to be mindful that if you're a $50,000 investor and you asked 100 questions, then most likely the deal will be full and they'll tell you, oh, sorry.
yeah, so
Maybe the
what,
next one is.
yeah, the best way I evaluate deals, for example, is I look at how is the syndicator thinking? How did they approach it? What is the homework they did? And then I use simple methods to go check up on that. But where to find the deal, we've had to use Facebook groups, investor groups, meetups, every kind of community related to this. That's where we've gone to find deals, or friends that we know are doing deals, or community events,
LinkedIn.
conferences. Yes, this is where we've gone to find deals.
Do you guys have any thoughts about, I know some of the better performing parts of industrial, and industrial was the top performing sector last year, but data warehousing, as well as just physical warehousing, having last mile storage facilities for distributors. Do you have any thoughts around those, or maybe a different sector of industrials is performing better and you have thoughts there?
Oh, like who's performing better? So I cannot do a predictive index. I need data. I'm a data person too, so I need data to make a informed decision. But generally speaking, we can say that this is going to be a huge need. And is it located, for example, next to a power plant, for example? Is it sourced well? What is the fallback if that fails? Do these people have operators like generators and things? Where does the data flow into? Let's say the servers are, everything is going to be moved to another center if something should happen. How well is that center protected? And then the background of that, for example, if you're evaluating countries, hopefully you don't have to, but how safe is that place? How economically stable is it? How economically stable is the market? And is it a short-term deal? Is the risk worth it? Is it a long-term deal? So these are the ways I evaluate, and your criteria could be different, but I usually go with track record, economics, that industries, like, is there a future in that industry that is a future for like 10 years? Is it a future like 20 years? Is it a 3-year future? And if the deal has a 5-year exit strategy or a 3-year exit strategy and the future of the business is 10 years, then why not, right? But if the future of the business is unknown and it's a 10-year hold, I'm going to walk away. I'm very conservative, so that's my thinking behind how we choose these kind of deals. Does
All
that
right.
answer your question, Daniel?
I think it does. Yeah.
Okay, thank you.
Let's
Together.
Oh, go ahead. We've got 5
We
minutes
put
left.
together. Yeah, I just wanted to say we put together a few resources because I know that what we covered in this meeting has been super high level. So we're happy to share a lot more in detail. How do you actually go about syndicating your own deals? Since I know a couple people have asked, how do I find my own deals? A second one is how to be smarter with your money. So this may be for people who are not yet accredited, who want to find a way to get to accredited status in the shortest amount of time possible. Or maybe it's someone looking for additional, because we didn't really talk about returns in this presentation or deal specific stuff, but how to actually maximize on the money that you already have, whether it be through tax advantages or ways to make higher yields. And then the third one is for people who are just interested in investing passively for now. We're going to have a presentation for those people. And this is not just about industrial. This is about pretty much every real estate asset that we've had experience in. So commercial real estate in general. And then also the PDF of these slides as well. So that's the infiniteperform.com/success now, or the QR code if anyone wants to get some additional free resources from us.
All right. Could everybody that's here take yourselves off mute and say thank you to Jen and Ganga?
Thank you.
Thank you.
Thank
Thank
you.
you.
Thank you, Jenny Ganga.
Thank you.
Thank
Thanks,
you.
guys.
How to reach out is send us
Thank
an email, invest@infiniteperform.com. Infiniteperform.com/success now.
All right. Thank you very much, both Jen and Ganga, and for coming in and talking a little bit about the different areas of industrial properties that you look at triple net leases and explaining that, and just going about your due diligence and lease audits and in negotiation. So thank you very much for that. And we will be putting the video for this up on our internal SharePoint site.
Great. Thank you, Daniel.
Have a
Thank
great
you for
weekend,
having
everyone.
us.
Thank you, Daniel.